In today's video, I'm going to talk about RRSP in 2023 and what are some changes you need to know in order to save more for retirement, so make sure you stick to the end. Hey, how's it going? If you're new to this channel, thanks for dropping by. My name is Thomas C. Chan. We have the most Vancouver life insurance and retirement 5-star Google reviews. And this channel is to help Canadians build tax-free wealth for their retirement and to protect you and your family using solutions that Canadian banks don't want you to know about. So enjoy what I have for you and let's get started. It's been a challenging year with the highest inflation we've seen since the 80s. And record interest rate increases, so especially important that you use your RRSP to your advantage to decrease your taxes and save for retirement. The RRSP, or known as the Registered Retirement Savings Plan, is a tax advantage account that's designed to help Canadians save up for retirement. It's one of the most important tax shelter accounts offered in Canada and a tax strategy most employees should be using. And so, let's do a quick recap of how RRSP works. When you put money into an RRSP account, you reduce the amount of taxes you paid this year and pay them instead when you withdraw and usually when you retired. And at that point, you should have a smaller tax bracket so you'll pay less tax in taxes. Yes, it is true that you still have to pay the tax eventually, but with an RRSP, you can control when you pay that tax and make a withdrawal when you'll be taxed the least. The tax shelter nature of an RRSP is very similar to the tax-free saving or the TFSA. The main difference is that with an RRSP, you get to reduce your overall income tax today, where in a tax-free saving, you focus on the growth tax-free for the future. So it depends what's your income bracket today and what's your future income bracket going to be. In an RRSP, you can hold almost any form of investment like stocks, mutual fund, bonds, ETF, or even cash. As long as these assets remain inside your RRSP, you won't have to pay any tax on them. And just as important, as they grow, you don't have to pay tax on those earnings, meaning you keep every dollar in your account. This is important because your investment will grow much faster inside the RRSP than they will in a regular non-registered account that will be taxed annually. For example, say Henry is 40 years old and he's currently making $100,000 per year. He puts away $10,000 into the RRSP. In theory, he will get around $3,000 in tax return. And now he put that extra $3,000 back to the RRSP to boost his retirement saving. And let's say with 20 years went by with an 8% return per year, instead of $494,000 saved, with that extra $3,000 tax return per year, the RRSP will grow to $642,000, and that's almost $150,000 difference with the same outputs and investment strategy. Alright, so that's how the RRSP works, but what are the changes this year? Previously, the maximum amount of money you were allowed to contribute was 18% of the earned income, up to a maximum of $29,210. So if your earned income was $60,000 last year, you have gained 18% or $9,900 on your RRSP contribution. If your earned income was $200,000 last year, 18% of your income is $36,000, which is above the maximum amount, so your contribution will still be limited to the maximum amount, which is $29,000 plus whatever room you carry over from the previous year. However, in 2023, the maximum amount you're allowed to contribute is still 18% of the earned income previous year, but the maximum amount has increased to $30,780. So the amount has increased $1,570, which is good news, especially for anyone earning more than $165,000 of earned income a year. But what counts as earned income? This includes all your pre-tax employment income, your net self-employed income, and any net rental income. As an example, let's say your salary is $60,000 as reported on your T4, but you also pick up a part-time job on weekends which got you an additional $10,000. And let's just say you rent out your basement and made $12,000. And if you add all those deeds together, you've got an earned income of $82,000. Now take 18% of that total and your RRSP room will be $14,760, well below the cap. Now, of course, a lot of people won't be able to contribute that much to the RRSP, especially if they have a young family or they're just starting out their career. In fact, according to Statistics Canada, the average Canadian contribute $4,000 to their RRSP, which means that there's still a lot of room left over. You can use that extra room when you get a raise, or if you have a huge capital gain like selling an investment property or stocks, you can use some of the money from the sale and put it towards your RRSP. If you're one of those average Canadians income earner, it's important that you don't feel bad that you have all these RRSP room left over. It's a good thing since it doesn't go away and in fact accumulate yearly until you reach the age of 71, which is the last year to contribute into the RRSP. And that's why it's wise to always keep track of how much room you have in your RRSPs. For example, if your employer offers RRSP matching, then it will also reduce the amount of room available in your account. Or maybe you sell your RRSP to buy a house or put your kids through the college. If that's the case, you'll be taxed on that amount. And unlike a tax-free savings account, once you take it out from your RRSP, the room won't reset. You don't want to exceed your available room because if you do, there are penalties. If you do exceed your contribution room, you'll be charged a 1% fee every single month on this excess amount. This equates to a 12% annual fee, which takes away from your retirement. Technically, the government allows you to contribute $2,000 above your contribution room before you get penalized, but if you're maxing out your RRSP, there are other strategies you can use to save on taxes. So please just talk to your advisor or accountants. In 2023, another important thing to know about your RRSP is the federal tax bracket are increasing without changing the taxable income amount. The government is doing this to account for inflation. This changes means the more income is taxed at a lower rate than before, which reduces your overall tax bill for all Canadians. But how does it work? In Canada, we have a marginal tax rate system, and there are 5 income tax brackets for the federal side. The tax bracket is based on your taxable income, which is your total income minus the allowable deductions and exemptions, meaning that if you make $200,000 a year, you're first taxed at 15% up to the maximum for the first tax bracket and 20.5% up to the second, and so forth. For example, in 2022, your income was $60,000. $50,000 will be taxed at 15% and the rest of $9,800 will be taxed at 20.5%. And where this year, now your first $53,000 will be taxed at 15% and the rest of $6,600 will be taxed at 20.5%. The difference may not be too significant, but it's important to plan with the accountant to better optimizing the RRSP contribution. Oh, and one more thing. Please keep in mind that RRSP is a tax-later tool, meaning there's no lock-in, you can take it out at any time. It's just that the withdrawal amount will be added towards your taxable income for that year and you pay tax accordingly. And that's why I always recommend that if you have 5 to 10 years towards your retirement, please double check with your accountant or financial advisor to see if it still makes sense to keep doing it. As we know, we're forced to take money out at age of 71, and if you're single and pass away, then the whole RRSP will be considered as your last year income, and easily half of them goes to the CRA. I know it's been a tough year for Canadians, and so hopefully these changes can really help you make a difference in how much money you give to the government while you're setting up for your retirement. If you have any questions, please don't hesitate to put them in the comments below or reach out to my team directly and we'll get in touch. Lastly, if you find this video helpful, please consider subscribing. It really helps the channel and enables me to provide more great content to help Canadians. This is Thomas. Thanks so much for watching, and I'll see you in the next video.